Did you know that 90% of individual investors underperform the market over the long term? And if you're thinking it's because they lack money, think again. One of the biggest mistakes investors make is not following the right habits. It's not about having the best stock picks, but about developing the habits of highly successful investors. If you can adopt these habits, you can beat the odds, even in a market that seems unpredictable. In this video, we'll dive into 6 habits that the best investors use to win, whether it's in good times or bad. These aren't your usual tips that you've heard a million times. We're talking about deep strategies, mindsets, and ways of thinking that make top investors different from the rest. Stick around to the end to discover how these habits can change the way you approach investing. Chapter 1. The Patience Perfection Principle. Slow and steady wins the race. One of the key habits of successful investors is patience. It's often said that time in the market beats timing the market, and this is especially true in value investing. Great investors understand that the real wealth comes over time, not from chasing quick wins. Warren Buffett is a perfect example. He has famously said, "The stock market is a device for transferring money from the impatient to the patient." Investors who rush into stocks looking for fast profits often end up with losses. But those who patiently wait for the right opportunities are the ones who succeed. Patience in value investing means waiting for stocks to dip to their intrinsic value. Intrinsic value is essentially the true worth of a company, based on its fundamentals, rather than market price. It's not about reacting to every market movement, it's about holding on to quality stocks for the long term. Buffett once stated, "Our favorite holding period is forever." When you understand a company's true value and its potential to grow, you can afford to sit back and let it build wealth over time. Research backs up this idea. Studies show that the longer investors stay in the market, the higher their chances of making a profit. For example, the average annual return of the S&P 500 was about 10% over the last 90 years. That's the power of time, not timing. So, whether you're investing in stocks, bonds, or real estate, patience is an investment habit that pays dividends. Chapter 2. Mastering the art of deep research. Digging beyond the surface. Successful investors don't just skim the surface, they dive deep. They spend countless hours researching companies, analyzing their financial health, and understanding their competitive advantage. As Benjamin Graham, the father of value investing, said, "The intelligent investor is a realist who sells to optimists and buys from pessimists." You need to look beyond the headlines and go deeper into the numbers. The best investors read everything, from quarterly reports to analyst opinions to industry news. But they don't stop there. They make sure they understand the company's operations, management, and market positioning. A good way to approach this is by asking, what makes this company different? If the answer is nothing, it's probably not a great investment. This research habit is crucial in value investing because it helps investors spot undervalued stocks. A great example is when Buffett invested in Coca-Cola in 1988. At the time, many analysts were skeptical, but Buffett saw its strong brand and international growth potential. He famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Deep research helps investors find those hidden gems that others might overlook. In addition to financial analysis, it's important to assess the leadership of a company. Buffett calls this the management factor. A company's management can make or break its future success. That's why great investors look beyond the numbers and assess the integrity, vision, and experience of the people running the business. Chapter 3. The Contrarian Compass. Thinking differently in a crowd. Successful value investors are often contrarians. They don't follow the crowd, they think differently. They buy when others are scared and sell when others are overly confident. In times of market panic, they're the ones picking up bargains while others are running for the exits. Be fearful when others are greedy and greedy when others are fearful, said Warren Buffett. This quote perfectly captures the contrarian mindset. Market trends and sentiment can be powerful forces, but they often lead to irrational decisions. In times of market hype, investors may ignore the true value of a stock, chasing trends instead of fundamentals. This is where contrarian investing shines. Successful investors go against the grain, seeking value in stocks that others might dismiss. They understand that fear and greed often drive prices away from their true value. For example, in 2008, During the financial crisis, many investors fled the market in fear. But Buffett saw it as an opportunity. He famously invested in Goldman Sachs when the stock price had fallen drastically. He even said, "Be fearful when others are greedy, and be greedy when others are fearful." While others panicked, he saw value. In fact, his $5 billion investment in Goldman Sachs made a profit of $3 billion in just a few years. This contrarian strategy isn't always easy. It requires conviction and the ability to think independently. But by sticking to solid fundamentals and ignoring the noise, successful investors often come out ahead. It's about trusting the data, not the emotions of the market. If you're finding this valuable, don't forget to hit the subscribe button for more tips on value investing. Chapter 4. Risk Management, Not Risk Avoidance. Navigating market storms. One of the most important habits of highly successful investors is mastering risk management. Great investors understand that risk is a part of investing, but they focus on minimizing it. Instead of avoiding risk altogether, they look for ways to protect their portfolios while still seeking growth. Warren Buffett once said, "Rule number 1, never lose money. Rule number 2, never forget rule number 1." This simple rule underscores the importance of avoiding unnecessary losses. To manage risk, successful investors use a strategy called the margin of safety. This concept comes from Benjamin Graham, who believed that investors should only buy stocks when they are priced below their intrinsic value. This cushion protects investors if the market doesn't perform as expected. By buying undervalued stocks, investors lower the risk of losing money. Diversification is another key risk management strategy. It's the idea of spreading your investments across different industries, companies, and asset classes. By doing so, you reduce the risk of a single investment hurting your overall portfolio. However, diversification doesn't mean spreading yourself too thin. It's about finding a balance between managing risk and staying focused on your best opportunities. Another critical element of risk management is understanding your own risk tolerance. Not every investor can stomach high volatility, and that's okay. By knowing your risk tolerance, you can create a portfolio that aligns with your comfort zone. Successful investors don't make impulsive decisions based on short-term market movements. Instead, they plan and stay disciplined in sticking to their strategy. Chapter 5. Learning from Failure. Rebounding. Strong success in investing is rarely a straight line. Every investor faces setbacks and mistakes. The key to long-term success is learning from those failures and using them as stepping stones. Legendary investor Peter Lynch once said, "The person that turns over the most rocks wins the game." And that's always been my philosophy. His words reflect the idea that mistakes are part of the learning process. Even the most successful investors have had their fair share of failures. Buffett, for instance, admits that he made a big mistake when he invested in Dexter Shoes in the 1990s. The company went under, and Buffett lost $3 billion. But he used that failure as a valuable lesson, understanding that poor management and changing industries could dramatically affect a company's future. Successful investors don't let failure discourage them. Instead, they view it as a learning opportunity. They analyze what went wrong, adjust their approach, and move forward. Each mistake helps refine their investing strategy. The key is to avoid repeating the same mistakes and to stay disciplined in following your strategy. Another important aspect of learning from failure is emotional resilience. It's easy to panic during market downturns, but successful investors stay calm. They don't make emotional decisions. Instead, they focus on the long-term goals and adjust their strategy based on careful analysis, not fear. This mindset helps them rebound stronger and smarter. Chapter 6. Consistency over time. The compound effect in action. The final habit of highly successful investors is consistency. It's not about making one big move and hoping for the best. Instead, it's about making steady, small decisions that compound over time. Albert Einstein called compound interest the eighth wonder of the world. When you invest consistently, you allow the power of compounding to work in your favor. Investing regularly, even with small amounts, can lead to significant wealth over the long run. Let's say you invest $200 a month for 30 years with an average annual return of 7%. By the end of 30 years, you would have nearly $300,000, even if you never added more than $200 a month. This is the magic of consistency and compounding. Successful investors don't just focus on market timing or short-term wins. They understand that real wealth is built by sticking to a plan over time. They invest regularly and let time do the work. This strategy also reduces the impact of market volatility because it spreads out the timing of your investments. Another aspect of consistency is keeping emotions in check. The market is full of ups and downs, but successful investors don't let fear or greed dictate their actions. They stick to their plan, regardless of short-term fluctuations. This long-term focus is what differentiates successful investors from those who chase trends. Studies show that consistent investing is one of the most powerful strategies for building wealth. A report from Fidelity found that investors who made regular contributions to their retirement accounts, even in times of market downturns, saw the greatest returns. This consistency pays off in the long run. Successful investors also know the importance of reviewing and adjusting their portfolios over time. While consistency is key, it's also important to stay informed and adapt to changing market conditions. Regularly reassessing your portfolio helps you stay on track and avoid unnecessary risks. These 6 habits, patience, deep research, contrarian thinking, risk management, learning from failure, and consistency, form the foundation of highly successful investors. By practicing these strategies, you'll be on your way to building a strong portfolio and achieving long-term wealth. Investing may seem complicated, but it all boils down to a few key principles. Stay disciplined, trust the process, and, most importantly, stay consistent. If you enjoyed this video, don't forget to hit the subscribe button and ring the bell for more expert investing tips.